When business enterprises depend on debt funds, a minimum level of capital, own funds, will be required for ensuring solvency of the enterprise. This means that even in extreme stress situations, the enterprise should be able to pay back fully its creditors. The capital funds, apart from bringing in the stake of the owner, also serves as a cushion absorbing any unexpected losses, which cannot be passed on to the creditors. When banks lend funds to the borrowers, they stipulate the minimum capital funds the borrower has to bring in to ascertain stake of the borrower as well as solvency of the enterprise so that the bank loans may be recoverable anytime. But when banks do the business of banking, what should be the capital requirement for the banks? What should be the minimum level of adequate capital whereby the depositors/creditors' interests are protected? The Basel Committee, under the auspices of the Bank for International Settlements based in Basel in Switzerland, issued guidelines for capital ratios for banks, known as Basel I in 1988 and Basel II in 2004, and has now come out with a new capital framework known as Basel III. In the aftermath of the global economic crisis, originated from the subprime mortgage lending by the banks in the U.S., that resulted in bankruptcy and failure of many banks, it was found imperative that the new framework should address these issues comprehensively to account for the risk-taking business of the banks. Briefly trace the developments in determining capital adequacy for banks under the Basel Committee. The Basel I was the first internationally agreed capital standard, which was issued in 1988. It linked capital requirement of the bank to the assets it owns and specifically was made dependent on the riskiness of the assets. Capital should be adequate to account for the credit risk. Thus, capital to risk-weighted assets ratio was considered appropriate for banking institutions to take care of the interests of the depositors and other stakeholders. The Basel I required that 8% is the minimum level of capital to be held against the sum of all risk-weighted assets. In 1996, the dimension of market risk was added to the framework of capital adequacy, wherein it was mandated that there should be enough capital to account for the volatilities in the prices of assets the bank holds in the form of securities, gold, and foreign exchange. Then in 2004, Basel II framework of capital ratio was introduced to further fine-tune capital standards for banks. Operational aspects such as failure of systems, procedures and personnel had caused heavy casualties for banks leading to their bankruptcy, and thus it was considered essential to account for the risks arising from such operations in the capital ratio of banks. Various methods were recommended to account for operational risk in practice. Also, as part of capital standards, apart from minimum capital ratio requirements, 2 additional dimensions were added for determination of adequacy of capital for a bank, capital ratio being subject to supervisory review process and disclosure requirements. The Basel II also allowed banks to use internal risk rating systems and approaches to measure credit and operational risk for capital purposes. Explain the circumstances leading to the revision of capital ratios under Basel III. The global economic crisis that emanated from banking crisis in the U.S. led to a rethinking on banks' capital standards. Inadequacy of capital cannot be stated to the sole cause of the crisis. But it was found that the existing capital framework did not take into account some of the most prominent risky business segments of the banks. Therefore, the coverage of risk-based assessment of capital needed to be extended. Capital adequacy had to address not only firm-level individual bank-level risks but also systemic risks which are beyond the control of individual banks. The issues of too big to fail/save and too interconnected to fail needed to be addressed in the new capital framework. Before the crisis, there was a belief that the big banks will never fail and that the system is too interconnected to cause any major disruption. So from the failure of the banks and financial systems, it was deemed necessary to strengthen them by more relevant regulatory standards and capital ratios. Risk assessment was based on value at risk, VAR, which was more appropriate for normal periods. It was based on normality assumption. The financial crisis events of the recent periods are considered to be tail events with low frequency but severe impact. These are also to be accounted for in any sustainable capital framework for banks. Again, abundance and imbalances of global liquidity are stated to be the prime causes of the recent economic crisis. But, once the crisis evolved, banks suffered from liquidity shortage, leading to bankruptcy of many banks. Thus, it was found necessary to address short-term and long-term requirements of sufficient liquidity for the banking system. What are the new major themes of Basel III? Capital ratio is defined as the ratio of capital to the risk-weighted assets. In this ratio, the numerator denotes capital and the denominator indicates risk-weighted assets. It is envisaged in Basel III to aim for better and higher quality of capital. The component of common equity will increase in the numerator of the ratio. As regards the denominator, better risk coverage of the assets is ensured. Aside from the basic capital ratio, there are two additional capital requirements in Basel III, capital conservation buffer and contracyclical capital buffer. These capital buffers are like shock absorbers in crisis times. A leverage ratio is introduced in Basel III as a backstop to the risk-based capital ratio. This will take into account total assets of the bank including off-balance sheet items, which had a phenomenal growth in the periods prior to the banking crisis. Basel III has two types of global liquidity standards which are meant to address short-term and long-term liquidity requirements of the banks. Systematically important financial institutions, SIFI, and systematically important markets and infrastructure, SIMI, are two important segments which can cause disruption to the financial system owing to malfunctioning. The banking crisis aggravated owing to failure of banks considered too big to fail and failure of the liquidity system considered too interconnected to fail. Basel III recommendations include developing standards requiring additional capital for SIFIs and setting up robust payment and settlement systems in place of over-the-counter markets. Thus, capital framework of Basel III has wider coverage to enhance the efficacy of the supervisory regime. How is Basel III related to earlier Basel Accords, 1 and 2? The scope and coverage of capital requirements have been amplified under the successive Basel Accords, 1, 2 and 3. The main theme of capital to risk-weighted assets ratio, CRAR, has continued from the Basel I Accord. The capital supervision framework of the banks has been demarcated as consisting of three segments known as Pillar 1, Pillar 2 and Pillar 3 under Basel II. The Pillar 1 consists of minimum capital requirements. The Pillar 2 pertains to supervisory review process and Pillar 3 overviews disclosure and market discipline relating to capital adequacy. Basically, the same supervisory structure has been maintained in Basel III. But there are enhanced requirements to be fulfilled under each supervisory mechanism. The capital buffers, leverage ratio and global liquidity standards are innovative developments under Basel III against the backdrop of the recent banking crisis. Also, the mechanisms to control SIFIs and SIMI are recommended under Basel III. Credit risk, market risk and operational risk are the risk factors for which risk-absorbing capital requirements were stipulated under Basel I and Basel II. Basel III accounts for an additional risk factor in the financial system called a system-wide systemic risks. Banks may fail owing to the failure of the other system components in the overall financial system. This necessitates extension of financial regulation from firm-level microprudential regulation to system-wide macroprudential regulation. These aspects are covered under Basel III. Is it correct to say that enhanced capital standards will curtail banking activity and thus economic growth? A robust banking system is essential for long-term balanced economic growth. Banks facilitate economic growth by mobilization of savings and by the process of credit creation that generate economic activities. It is criticized that stringent capital requirements will constrain banks' activities that will eventually choke economic growth. But economic growth has to be a balanced process devoid of extreme volatilities of boom-bust cycles. Risk-based capital requirements are not supposed to make banks risk-averse, but risk-cautious. Thus, risk mitigation is intrinsic to essential banking activity, facilitating orderly balanced economic growth. Excessive leveraging, lending and risk-taking, not related to core banking activities, are stated to be antecedents of the banking crisis and the subsequent economic crisis. Insolvency and bankruptcy of the banks can cause devastating impact on the economic development. A sound and strong banking structure is reflected by higher qualitative capital standards as indispensable for long-term economic growth. What are the enhanced capital standards under Basel I? Basel I stipulates capital ratio as 8% of risk-weighted assets, RWA. Thus it may appear that there is no change in capital requirement from the Basel II, which had also stipulated 8% of RWA. But Basel II raises quality of capital. There are three elements in the capital equation: the numerator showing capital, the denominator denoting risk-weighted assets, and the capital ratio itself. The total capital is composed of two parts, called as Tier I and Tier II. Tier I consists of common equity funds and preference shares. Tier II consists of long-term debt, called as subordinated debt, which are payable after meeting other creditors' obligations, in case of liquidation. The component of tangible common equity capital is raised to 4.5% in the total capital ratio. Under the Basel II, the minimum tangible common equity capital requirement was 2%. The Tier I capital should form 6% as against minimum 4% stipulated in the earlier accord. Thus, the share of Tier I capital and the share of common equity in the capital ratio have been enhanced, causing a change in the quality of capital. Common equity has the highest loss-absorbing capacity, and hence enhancement of the share of common equity will result in improvement in the quality of capital ratio itself. The component of Tier I capital will decrease to 2% from the earlier 4% of the RWA. The Tier I capital will have a loss-absorbing capacity on a going concern basis. That is, the financial institution is solvent. Tier I capital, mainly subordinated debt, will have loss absorption capacity as a going concern basis, that is, following insolvency and liquidation. Thus the focus on tangible common equity and Tier I capital and the capital ratio is one of the breakthroughs of Basel I. Regarding the denominator of the capital ratio, the Basel I substantially improves the coverage of risks relating to trading book, securitization products, counterparty credit risk on OTC, over-the-counter, derivatives and repos. The banks had a substantial increase in these types of assets, even though risk-weighted assets had only modest increase. By covering many of these asset classes with higher risk weights, there will be a quantum increase in the calculation of risk-weighted assets and thus resulting in higher capital requirements. Thus, with enhancement in the quality of capital and expanded risk coverage of risk-weighted assets, capital standards and ratios are strengthened under Basel I. Even though capital ratio is kept at 8%, owing to expanded coverage of asset class and risk weights, capital requirements will be substantially higher for internationally active banks. What is meant by capital conservation buffer under Basel III? In addition to the basic capital ratio of 8%, with subcomponent of 4.5% of common equity capital, a capital conservation buffer of 2.5% in the form of common equity is also mandated under Basel III. Thus total capital ratio will be enhanced to 10.5% with a subcomponent of 7% of common equity. Banks are to build buffers of capital in good times, and these capital buffers can be used to absorb losses as the economy begins to contract. Therefore, banks are required to retain a higher percentage of the earnings towards capital. There will be restrictions on distribution of profits towards dividends, bonuses, share buybacks, etc. for banks which do not keep capital conservation buffer, especially in periods of financial stress. Inclusive of capital conservation buffer in the form of equity capital, the component of tangible equity capital will form nearly 83% of the Tier I capital. What is meant by contracyclical capital buffer under Basel III? The lessons from the recent banking and economic crisis prompted formulation of this capital requirement. This will arrest what is called as procyclicality behavior of banks. In boom period, there will be higher credit growth, and in stress period, there will be contraction of credit. This results in aggravating the cyclical process. Contracyclical capital helps in applying brake on credit growth in boom period. This also helps in more lending to take place in stress times. The Basel III recommends 2.50% of RWA as the contracyclical capital buffer, in the form of common equity or other fully loss-absorbing capital. Thus, the introduction of a contracyclical capital buffer to mitigate procyclicality is an innovative feature of the new capital framework. What are the objectives for incorporating leverage ratio and liquidity standards under Basel III? Capital ratio is based on risk assessment of assets. But prior to the banking crisis, there was huge buildup of assets, on and off balance sheet, which were not adequately risk measured. Thus total assets were a multiple of risk-assessed assets. In order to address this situation, a leverage ratio has been introduced. This is a non-risk-based ratio, that is, assets are not risk-weighted and should be 3% of the total assets to be met by Tier 1 capital. Thus leverage ratio supplements risk-based capital ratio. Further, leverage ratio will be included under Pillar 1 from 2018, thus making it a necessary minimum requirement for the individual banks. Liquidity crunch was stated to be the immediate cause of the bank failures. Liquidity coverage ratio, LCR, is proposed to ensure that high-quality liquid funds are available for 1 month survival in case of a stress scenario. Global minimum standards for LCR will be effective from 2015. A net stable funding ratio, NSFR, will measure availability of more stable sources of funding on an ongoing structural basis. There will be more effective monitoring of maturity mismatches, concentration of funding, and availability of unencumbered assets. NSFR minimum standards will be effective from 2018. How does Basel III cover systemic risks and extend to macroprudential regulation? Systemic risks emanate from the failure of the aggregate system, and this requires macroprudential regulation. Microprudential regulation looks into firm-specific risks, and the basic capital ratio covers these risks. But the recent banking crisis pointed towards some of the systemic risks, such as excessive leverage, existence of too-big-to-fail institutions, imbalances in liquidity, procyclicality, the notion of interconnected-to-fail systems, etc. It is broadly agreed that systematically important financial institutions, SIFI, should have higher loss-absorbing capacity and more capital to reflect greater risks that they pose to the global financial system. This will be by way of systemic capital surcharge, contingent bonds convertible to equity, and bail-in debt. The exact quantum and quality of the capital will be decided by mid-2011. Systematically important markets and infrastructures, SIMI, also pose moral hazard. The failure of the liquidity system was owing to interconnectedness and the cascade effects generated by it. Basel III endorses central counterparty clearinghouses for derivatives and recommends higher capital requirements for bilateral derivatives. The concentration of systemic risk will be minimized by effective supervision. How does Basel III improve risk management and risk modeling of banks? The banking crisis highlighted the inherent weakness of banks' risk management based on risk models. Risk measurements on value at risk, VaR, were based on normality assumption and did not account for stress events, tail events, which may be rare but will have severe impact. Therefore, VaR approaches have to be supplemented by rigorous stress testing programs that can better capture tail events, systemic risk events. Stress testing should be an integral part of the internal capital adequacy assessment process. Also, the regulators cannot solely depend on the internal risk models. The supervision of large banks will need to be more intrusive for validating banks' internal models. How was the implementation of Basel III framework scheduled? The Basel III Capital Framework, prepared by the Basel Committee, has been endorsed by the G20 leaders at the Seoul Summit in November 2010. The implementation of Basel IE standards will commence from January 1, 2013 and will be fully operational from January 1, 2019. This staggered implementation is meant to help banks to raise capital by internal surplus and external fundraising to meet the higher standards. The core capital ratio of 4.50% by way of tangible common equity should be reached by banks by January 1, 2015. Capital conservation and contracyclical capital buffers of 2.50% each will have to be met by January 1, 2019. The contracyclical buffer will be implemented according to national circumstances. Basel Accords are voluntary agreements. The countries signing the accord agree to implement the standards through national laws or regulations. There is considerable discretion in implementation of the rules by the individual countries. Basel III is not a brand new capital framework. Basel III is Basel II plus the lessons learned from the recent banking and financial crisis. An enhanced capital framework under Basel II will engender a stronger banking structure, facilitating orderly economic progress for the nations.